So that is for short straddle, strangle and the long straddle, strangle. Okay, so we are going to see the short option now. Hi friends, Chitra here. Welcome to my YouTube channel. Today we are going to learn the straddle, that is an option strategy. So what is called straddle? A straddle is a trading strategy that involves options. So to use the straddle, a trader buys or sells the call option and the put option simultaneously for the same underlying asset. Okay, so at a certain period of time, both the options have the same expiry date and with the same strike price. So when you're doing the straddle, it should have the same expiration date, that can be weekly or the monthly expiry date, and with the same strike price. So we are not using the different strike price. Say for example, if you are trading doing the straddle with the Nifty, and it should be the 22,500 call and 22,500 put. It should be of the same strike price of the call and the put. A straddle strategy involves two transactions in options on the same underlying with the opposite positions, either call or the put options. A straddle involves buying or selling a call and the put option with the same strike price, and it should be of the same expiration date. So this is called straddle. Okay, in straddle, if you are doing the straddle, it should be of the same expiration date and with the same strike price. Okay, so either we'll do the call or with the put options. Okay, so next is, what are the two types of straddle, that is long straddle and the short straddle. Long straddle means one holds the long, that is buying both call option and the put option. Here the risk is limited and the reward is unlimited because we are buying both call and the put. Here we are not selling, here we are only doing buy. Okay, that is called the long straddle. Next is short straddle. Short straddle means one holds the short, that is they will do the selling of both call and the put options. Here the risk is unlimited and the reward is limited. Okay, as a result, it involves the purchase or sale of particular option derivatives that allows the holder to profit based on how much the price of the underlying security moves, regardless of the direction of price movement. Example, in Bank Nifty, if we are doing the straddle, it should be of the same expiry and the same strike price, that is 48,500 CE and 48,500 PE of the same expiry. In straddle, there are of two types, that is long straddle and the short straddle. So, long straddle position is created by buying a call and a put option of the same strike and of the same expiry. Okay, so this is called the payoff chart. Here we are using the Bank Nifty. I have shown with the Bank Nifty example. Okay, this is called the payoff chart. This picture is the long straddle created with the 48,600 CE and 48,600 PE. This is of the same strike price of the call and the put and of the same expiry. Alright, here the margin required to buy is, here we can see the margin, that is 226 and 227. So this is the premium, totally 6.8k. In case if the market doesn't move till the expiry, the trader may lose the premium. Okay, so this is the premium. Also, if you see here, buying these two options, trader paid 460 plus rupees. Next, what we have to understand is when we will be in profit. Okay, the position will come to profit. Okay, if the spot price is below, spot price comes below 48,147 or spot price goes above 49,053. So this is called break evens. Alright, so this is called long straddle. So this is the example I have shown with one lot. Here we can see the one lot of the Bank Nifty, same strike price and of the same expiry. Here we can see the estimated margin, that is a premium altogether to create one lot for Bank Nifty or to create the long straddle. What is the amount we have to pay? That is 6,800. Okay, and what is the maximum loss is also 6,800. Okay, break evens, that is when we will be in profit if the price is, that is spot price of the Bank Nifty is below 48,147 or if the spot price goes above 49,053. Alright, and the maximum profit is undefined. So this is the long straddle. So what is called short straddle? So a short straddle position is created by selling a call and a put option of the same strike and with the same expiry. So in the short straddle we are selling the call and the put option, but in the long straddle we are buying the call and buying the put option. Here we can see the example shown with one lot of the same expiry, that is 48600 CE and 48600 PE of the same strike price. The premium is 226 rupees for the call and 227 rupees for the put option. The maximum profit is 6802. That is the maximum profit, because as we are selling here, we will get the premium. In case of the short straddle, the trader receives the premium as we are selling the call option and the put option. Okay, and also the risk is unlimited in the short straddle. The position will come to profit if the price is in between 48,147 and 49,053. So this is the example for the short straddle. All right. So we should know few details if we are doing the long straddle. So when to trade the long straddle? So expected volatility. Okay. If you are doing the long straddle, there should be volatility in the market. So when we expect a volatility in the market, like RBI events or any major results is coming in that day or that week, we can do the long straddle, because either side movements will be there, okay, and there should be volatility in the market. So then we'll be in a profit. All right. So when to do the short straddle, we should receive the premium in the short straddle. Why? Because we are selling the call and the put. Okay, and there should not be much volatility. So in that case, we'll get the premium what we paid. Okay, so there should not be much volatility also if you are doing the short straddle. All right. Then the margin required. The margin requirement for the long straddle, we need to buy the call and put. So the premium is the margin required for long straddle. What about short straddle then? For short straddle, we need the full margin. Okay, so but what we have to do is we need to check with the broker terminal, as it is we are doing the selling the call and the put. All right. Next is monitoring the positions in the TradingView. So I have developed an indicator and published in TradingView. So we'll see that now. So we will see our customized indicator. So if you come to the TradingView, click on the indicators. There type the TCLC options straddle strangle chart. Click on that. So it will be loaded in the different pan. Okay. So the link also available in the description box below. All right. So we can see the indicator here. Okay. Down. Okay. Below the below the chart, we can see the indicator. Click on the settings of the indicator. Okay. So there are multiple options available. So under the inputs, okay, we can see here that is short, long. So that is for short straddle, strangle, and the long straddle, strangle. Okay, so we are going to see the short option now. So click on short. Again, we have an option for call and the put. So here we are going to select the call option. That is the strike price we are going to select is the spot in Nifty is 22,700. We can see that the spot is at 22,700. So we are going to select the 22,700 call. Okay, click on that. And for the put also 22,700 put. Okay, as we are doing the short straddle here. Okay, of the same strike price and the same expiry. And click on OK now. Assume that we are taking the position, that is short straddle, at 9:25 AM. That is when the price is at 22,700. Okay. So now we can go to the indicator below. We can see three lines, that is blue line, red line, and the green line. So the green line is the call option, red line is the put option. So what is this blue line? Blue line is the combined premium of both call and the put. And we can see that we have taken the position, and at that time the consolidated premium of both call and put is at 107. Okay. So the combined premium is at 107 at 9:25 AM. Alright. So from 107, the premium got decayed and the call option closed at 53 rupees and the put option closed at 0. So what is the premium? The current premium we can see here that is 46.2. Alright. So now we can see this in the replay mode. Okay. So from 9:20 I have enabled it. Okay. And here when we comes to the indicator, the symbol it shows the Nifty. This is for the C is for the call and P is for the put option. Alright. And this CMP, this indicates current market price. So for the call and for the put. So it indicates S also, S and long, short and long. So we are doing short straddle here. So it is S. Alright. If this column is in green, the position is in profit. Okay. If this column is in red, it means that the position is in loss. So now we will see one more example with the Bank Nifty. Okay. So select Bank Nifty. Alright. Okay. So here we can see that the spot is at 48,700 plus. So we will we will go to the settings and we will select the call option and put option as 48,800 CE, 800 call, and put option also 48,800 put. Now, so 48,800 put option. Okay. So again we have to change the position premium. We have to change it manually, the position premium, that is a combined premium of both call and put, how much it is. We have to combine and we have to punch in there. So it is at 312. We can see here the blue line shows the combined premium. So accordingly we have to punch in the premium, that is at 312 we have punched it. Okay. Now click on OK. Now we will see the same in the replay mode for the Bank Nifty also, how the premium changes in the live market. That is, if the position is in profit, it will be green in color. If the position is in loss, it will show in red in color. Alright. So now it shows that we are in the profit of 70 plus points. Okay. So according to our risk management, we can close our positions, and according to your risk management, you can book your loss or you can book your profit. Okay. So currently we are in 86 points profit. Now it is 100 plus points profit. So if we are good to close the position, we can close the position now also. So we got good profit in Bank Nifty in one lot. Okay. Now the position is showing 158. So this is we are doing for the intraday. So we have to close the position for the same day as it is of expiry, weekly expiry. We are closing on the same day. So when you see here, when we have taken the position at 312 and while closing, the premium came to 186.75. So we are in a profit of 125.25 points. Alright. Hope this video is useful to you. Please don't forget to like, share and subscribe. Click the bell icon too for my upcoming video notifications. Thank you for watching.